this computer. We're going to run through as much as we can on market efficiency, just because they make sense, okay? And then we're going to look at some options. Then either on our next session, which would be on Wednesday, we're going to add a little bit of some option futures if we were not able to go through all of it. But what's really cool is that today's session is going to be super duper comprehensive. I think the work is pretty cool. And you'll also have homework. Please, if you could do, I think it's cool because you get to send me pictures of your work. And I know some of you guys do it. And it could be a really cool way for you to be held accountable, to double down on the material, and to just do amazing on the final, because I really think it's possible. It's really a question of just putting in that little accountability type of thing going. So anyways, that said, let's give it a shot and let's have fun. We're on a good little vibe here. So that said, did anybody here start looking at market efficiency? Is this something that you've seen in class, or is it like the first time ever? So nothing about market efficiency or options. Lean, Rami, what do y'all think? No? Okay. And then in class, what chapter are we at now? What chapter are we at right now in class? Because I'm concerned to see that that's not covered yet. In class, what chapter are you guys covering, like today or tomorrow type of thing? If somebody could write in the chat. Not going to class? Okay. What about Lean or Rami? What are the chapters covered in class, like as of this week? I have been told today we finished chapter 12. Okay, so today you finished options. Okay, and did your professor talk about market efficiency by any chance? Like, is that something you're seeing next class, or is it something that we're just gonna avoid? Like, what's up? So like what it is, honestly. Okay, well, let me just double check then. I know a student told me where they were at. Give me a sec. That's market efficiency and options. Okay, well, listen, all this to say, at least you're going to get chapter 12 out of the way now. This chapter is chapter 10. Okay, so technically today what we're doing is we're doing chapter 10 and chapter 12. And you should be on the same page. So let me ask Palmville, what are you guys looking at this week in 308? Like, what is the materials and or topics covered?
Like in class?
Yeah.
So it's so my professor is a little bit more like fast-paced. So today he's finishing capital budgeting and starting cash flow estimation. And on Wednesday, I think he's finishing the entire course, like the entire material. And on Monday, he's just gonna do the review and yeah.
So you've already seen technically in class market efficiency and options, yeah?
Yeah.
Okay, perfect. Okay, good. So we're kind of on track, and then tomorrow and or Wednesday, we're going to jump into cash flow estimation and capital budgeting, and it's going to be pretty easy and fun. I'm going to do some classic exam questions. Okay, so that said, good. I know where we're at, and with that, we're going to be able to kind of make sense of this whole market efficiency thing. I think it's super straightforward. It's super fun. So market efficiency, essentially, what we're doing with this concept of market efficiency is we're really trying to figure out to which degree do prices in the market reflect what's available, okay, right, in terms of information, and what is available in terms of relevant information. So we're just trying to see, well, for example, the price of Tesla, the price of Nike or Netflix, is that price, okay, representative of all the different types of information that one could gather? Obviously, we're sharp, smart people, and we like to use information to make strong decisions. And we could essentially try to break down these decisions, okay? We could try to break down these decisions into 3 buckets. And these three buckets essentially will represent to what extent that information is absorbed and or reflected in the price in the market. So if we want to continue with this idea of like Nike, well, to what extent is, yeah, what's up? Okay. So to what extent is Nike's stock price reflecting historical data, public data, and then private data? That's essentially what we're going to do. And that's a pretty cool thing to do. And I guess one thing, just to make it interactive and to see where you're at, let's say that you are best friend, okay? You are best friend with Jeff Bezos, and Jeff Bezos would tell you every single thing that would happen to the company before it was public, before anybody else would know. Do you think you would have an advantage in comparison to other people investing in Amazon? What do y'all think? If Jeff Bezos was your best friend and he gave you all the information about the company, he told you, hey, we're going to do this, we're going to do that, we're going to buy this company, we're going to merge with them. Do you think you would have an advantage versus other people investing into Amazon? Yeah, 100%. You would be able to buy the stock at the right time, and you'd be able to sell the stock at the right time. You'd be able to decide what you would want to do with the stock because you have the best. You literally have Jeff Bezos giving you, a little pat on the back, telling you what to do. Okay. And then let me give you another example. Let's say that every time there's a full moon outside, okay, out of your window, the price of Nike would drop by $1,000. Okay. So every time there's a full moon outside of your window, the price of Nike would drop by a large amount. You would probably decide to sell your stock before that full moon comes out, right? You would say, you know what? If I know every time there's a full moon outside and I own some Nike stock, I'm gonna probably sell it because I know it's gonna drop by a lot of money and you're gonna lose some money. And this is my very clear, unfunny, and not very strong example to tell you a little bit about the different things we could do when we want to analyze a stock. When we want to analyze a stock, we look at a bunch of different things. Now, what's interesting is that these different things may or may not be as relevant depending on what type of market we're in. Okay? Now, could somebody tell me, it's written on the screen, but what type of markets could we have? There are three. What type of markets could we have? Could you kind of just list it in the chat? There are three types of market. You may or may not see it on the screen. I just want you to write it in the chat. What type of markets could we have? What type of markets could we have? Yeah, weak, semi-strong, and strong. Okay, these are the three main markets that we have. Okay, amazing stuff. Now, let's try to break down this idea of a weak form market efficiency. Okay, in a weak form of market efficiency, there are two things that you want to look at. You want to look at this idea of technical analysis. That's something that's going to be totally related to the weak form, and we're going to talk about it more in a second. And then there's also this similar thought that's called the random walk. A random walk, essentially, it states that a price of a stock today is not related to the price of a stock tomorrow. We're going to talk about that a little bit more in the next slide. But when you think about weak form market efficiency, I need you to always remember these two things, okay? Technical analysis or fundamental analysis and the random walk. These are three little titles that you need to attach or associate to the weak form. Now, to kind of tie a bow to this idea of the weak form market efficiency, I need you to remember one thing, okay? And we're gonna really dive in a little bit more into each, but this is a high picture view of what we're doing, or 20,000 feet picture of what we're doing, is that when we're in a weak form type of market, the prices in the market are only gonna reflect one singular type of information. And that one singular type of information that a weak market will show is historical information, okay? A little bit. We're gonna look more into it. I actually have a graph for you, but that's a pretty good tie to have there. But the weak form market efficiency, what you wanna remember is that market prices will reflect all past prices, okay? So historical information, all right, such that it's impossible to look at past prices to beat the market. That said, let's move on to the second type of market efficiency. The second type of market efficiency is what we call semi-strong. So it's like kind of good, but it's kind of bad at the same time. Okay. And the most important type of thing you need to remember when we're discussing when we're discussing a semi-strong form type of market, is that you need to understand that public information is totally incorporated in the market prices. Okay. What is public information? Can somebody tell me in the chat what could be sought as being public information vis-a-vis a stock or a company? What would that be? Okay, so Bashir says news release. Does somebody else have like a random idea? Like anything is good. I just want to kind of see where you're at. So Bashir says news release. That's totally factual. Hell yeah, quarterly results. Exactly. So this essentially means that if you were to look at Bloomberg or Yahoo Finance or CNN or Wall Street Journal, okay, or if you were going to look at the company's filings, like its 10K, like its financial reports, its quarterly results, all those things would mean nothing to you because they wouldn't be able to create a competitive advantage in choosing or making any investing decisions, okay? The reason why it wouldn't help is because you need to assume that within these forms and within their like requirements or restraints, that everybody else will do the same thing, okay? So what does it mean? This means that under a semi-strong form, okay, public information is something that everybody else would look into. And if everybody else would look into that, then technically we're all able to make similar decisions. And for that reason, public information would already be priced in because everybody has access to the same information on a day-to-day basis. So we would say that market prices are reflecting all past prices and available public information because everybody has access to that. And we need to assume that we're all, rational investors, and public information would not be a strong levy to make a strong buying decision. So once again, we're only looking at this at glance for now. The next slides are much more involved. So with that said, the final form of market efficiency will be the strong form, okay? The strong form is like, the classical theory. If we say that a market is efficient, we're saying that it's strong form market efficient. And the only like additional thing you want to remember for a strong form, so for a strong market, is you want to understand that private information is already priced in the stock, okay? This means that one could not use private information to beat the market. This means that one could not use insider information to choose a stock because all private information is also priced in the market price, okay? So if we go back to this idea of Jeff Bezos, okay? The relationship you have with Jeff Bezos, he's giving you like confidential information. Would that be considered as insider information or like private information? Like yes or no in the chat. Would that be considered as, okay, yeah, 100%. So that's what we mean by insider information. Insider information or insider trading is highly illegal. You are not allowed to do that. It's unfair and it creates imbalances in the market. So no bueno, don't do it if you ever get to have the chance to do it. Listen, that's a whole different topic. Yeah, they're able to track your stuff way more than you think. And I'll actually share a story on the next few slides. So manipulating the market privately is very, very, no bueno, okay? But to tie a bow on the strong form market efficiency is you want to remember that market prices reflects all past prices, all available public information, and all available private information, okay? Now, what I want you to understand here, and I hope you saw the pattern, okay? If you are a strong form, okay? If you are a strong form of market efficiency, by definition, you are also a semi-strong form, and you're also a weak form. Do we all see that? The constraints that are attached to the weak form and the semi-strong form are by definition also attached to the strong form. Does that make sense? Notice how here it says past prices, public, and private. Okay, cool. Now, by that same token, if you are semi-strong form, if you're dealing with a semi-strong form market efficiency, by definition, you are also weak form, okay? Notice how at the bottom it says all past prices and all available public information are included. Now, lastly, if you are a weak form, then by definition, you are only a weak form. You cannot go back to any other form, right? Because there's just no, order there. Okay, so that's kind of like the big picture. Now you're introduced to the topic. You're familiar with this idea. We're super happy. Now we could dive in much more into this concept, into like the granular steps of market efficiency. So what we're going to do is we're going to look at weak form, then we're going to look at semi-strong form, then we're going to look at strong form, then we're going to tie it all up with a summary. We're going to do some practice questions, and then we're going to jump into some options and futures. Okay, so let's check it out. The weak form market efficiency. Now, once again, if we start at the top, if we go at the summary, we understand the definition. The definition says that in a weak form, okay, in a weak form of market efficiency, market prices reflect all past prices. So all historical information. Very clear. That's the idea. Now, what I'd like to kind of like talk about a little bit more would be this idea of A, technical analysis, and then B, the random walk. They work really, closely together. You can't have one without the other. So it's kind of like, the chicken and the egg, which came first. So they kind of, they're interrelated. So that said, let's try to make sense of technical analysis. Technical analysis is a broad type of study. It's something that a lot of people do. It's something that if you were on YouTube in the last decade, you probably saw some ads of a guy on a chair like this with a camera right here. And he says, do you want to make money? Do you want to be rich? Then they try to sell a course. Those are the dudes that do technical analysis, okay? And technical analysis, essentially what it is, it's just studying. I still see it, me too, exactly. So technical analysis is the study of past stock prices, okay? It's a study of essentially, let's say we were technical analysts, we would look at, let's say, the price on June 2021, and we would try to find a relationship every every 6 months or every 3 months. We would be like, okay, so if the price is here on June 2021 and the price is here on September 2021, but the price is here on December 2021, obviously it seems that the price is always going up every 3 months. Therefore, what you want to do is you want to buy, at a specific date and then hold for 3 months because you're going to make a better investment. Essentially, it's kind of just trying to find some sort of patterns in past prices, okay, to beat the market. Now, this was a ghetto and very bad way to explain it in terms of like an example, but really what we're saying with technical analysis is that we're doing the study of past prices in order to have a competitive advantage in the market to obviously beat the market. So that's what they're doing. We're studying past prices. In this case, obviously, this little trick that I said, so every 3 months, your stock price will go up regardless of what happens in between, is false. Because right here, as you can see, every 3 months, our stock is actually falling. So that rule does not work. So clearly, if we're looking at Microsoft's stock, technical analysts would not be winning with that type of analysis. For sure, it could be more complicated, but once again, the general idea here is that looking at past prices to try to beat the market. That's what a technical analyst would do, okay? Now, the reason why that doesn't work, there could be many reasons, okay? But I guess the common denominator here is that we believe, not we, because I'm not a PhD or whatever, but professionals and teachers and academics believe that stocks follow what we call is a random walk, okay? A random walk essentially says, in a very simple manner, is that the price of a stock today has no effect to the price of a stock tomorrow. There is no correlation between the price today and the price tomorrow. And to visualize that for you, we could use our graph here. As you can notice, we have our time slots. So we have June 2021, September 2021, December 2021, all the way to March 2022. So there's a span of 3 months in between each like little line on our horizontal axis. And then on our vertical axis, we have our prices. I feel like that's clear for everybody. But what the random walk is telling us, we could choose arbitrary lines. So we could choose June 2021, September 2021, December 2021, and then March 2022. And we could say that according to the random walk, okay, that the price on June 2021 had essentially no like relationship, okay? No specific relationship with the price in 2021. What we're saying is that Microsoft's stock could have went up, could have went down, and it could have stayed the same. We actually don't know. We could never predict that. There are so many factors at play. For example, government policies at play. What the CEO says is at play. The morale of their employees at Microsoft. A pandemic is at play. These things we could literally not predict. And if you can, you may be the next prophet, okay? So that's what the random walk is all about. It's telling you that there's so many different factors at play, and we could not dictate in which direction it'll go. So in other words, there's no clear correlation between the two. And I'll tell you a little anecdote, which I thought was super interesting. And I'll stop talking and I'll kind of ask you where we're at after this. But when I was in Asia a few weeks ago, I went with a friend of mine who's a very sharp guy, and he likes to study, history and stuff of that nature. And we were talking about the 2008 recession, why it was interesting, how, does analysts try to make sense of why did the recession happen then? And we came to a very specific inflection point in our conversation. That being that a lot of analysts in 2008 and like right prior to that believed that a recession, only a few of them believed that a recession was like inbound. However, none of them knew when, okay? And that's a beautiful thing to understand. They knew a recession would happen, but they didn't know when. They didn't have a reason for which it would happen on Thursday instead of Tuesday. That's because stocks follow a random walk. We have no idea how the effects of things would go together. And this is even more interesting when we look at the 2008 recession, literally almost 14 years removed in 2022. Analysts and academics are still struggling to understand why did it crash at that date. They can't figure it out. That's extremely, extremely relevant. And the underlying reason here is that it follows this idea of the random walk. We cannot predict anything based on past information, okay? So that's pretty interesting. Now, before I go towards the implications and like the wrap up of the week 4 market efficiency, I would like to ask you a question. How are you feeling? Is this making sense? Is this complicated? Do you have any questions? Okay. What about, okay, makes sense? Perfect. Ravi, does it make sense? Do you feel comfortable? Amazing. So what I'd like to do here is I'd like to kind of look at the implications tab. For the next 2 slides, the implications tab is going to highlight in blue the information that is priced in, and it's going to highlight in gray the information that is not priced in. Okay? That's very important to understand. Now, what does that mean? Let's look at it twofolds. So the implication, what's highlighted in blue in those gray boxes, it's telling you, hey, everything that is historically like historical prices, okay, past information will be essentially priced in a stock, okay? So the price of Microsoft's stock right here has priced in all of its previous information, all of its previous prices. Is that clear with everybody? So the price right here at point A has priced in all of Microsoft's historical prices, all of its past prices. Are we like on the same page here? Yes or no? I see one yes. Okay, cool. However, what it is not pricing in, it's public information, and it hasn't have priced in private information, okay? These two things are not priced in. So what does that mean? This means that under a weak form, okay, of market efficiency, only past prices will be priced in into Microsoft's prices, okay? But by that token, public information on Microsoft and private information about Microsoft are not priced in their stock's price. Are we seeing this? Are we on the same page? That's what these boxes at the bottom are trying to highlight. Okay? Very important. That's what I'm trying to highlight in this little thing here. Now, we could also look at it from the next perspective, like from this antithesis. We could look at it from like an opposite angle. So by definition, if all past prices are the only things that are priced in Microsoft's stock, this means that all public information and all private information is not priced in. So if this is highlighted, this means that these two right here, public and private, would not be highlighted. So essentially, I guess in a not so clear way, what's highlighted in gray essentially is what is not priced in. And this is going to be important for you when you try to solve questions, like multiple choice questions. Using this framework will make it easier for you. You'll see what I mean later. Anyways, so the summary of the weak form market efficiency is at the very bottom left of this page. And it's saying that, hey, investors can't beat the market by studying past prices. Notice it's highlighted in blue, okay? However, they can beat the market by using public and private information. Notice it's highlighted in gray. So the way you want to look at this when we try to make a statement on these different forms is that investors can't beat what's highlighted in blue in the gray boxes, but they can beat what's highlighted in essentially gray in the blue boxes. I feel like that should be clear for everybody. So that's essentially the wrap up for the weak form market efficiency. With that said, do we have any questions? Are we good, or are we ready to move on? What's up?
So so the gray boxes represent the prices,
It represents what's priced in, like what's included in the price.
and the blue boxes, they are the information available, like used in determining the price, right?
Yeah, that can be used. Exactly.
That can be used. Okay.
Yeah.
So let's say, just one sec. Okay, yeah. So in the weak form, only the past prices are past information. Oh no, past prices are used,
Exactly.
and
Yeah.
no public or
Past
private.
prices are included in the price. So this means that you cannot use it because it's already priced in. Why would you try to analyze past prices to find the price of the market if it's already priced in? Does that make sense?
Yep. Okay. Yeah, thanks.
No worries. Any other questions? Any other ideas? How are we feeling? Okay. So we're going to move on to the semi-strong form. I'm going to try to make sense of it. So the semi-strong form, just to give you a quick summary, once again, it states that market prices reflect all past historical information, so all past prices, and all available public information. So as you can see on the left-hand side, I guess I should do like this, or maybe it's mirroring my webcam, I don't know. As you can see on the left-hand side of our slide, you see Elon Musk, and you see this thing here that's called Form 10K and Apple Inc. Okay? What I was trying to highlight here is that these are two different forms of public information. This is Mr. Elon Musk talking at a press release, at a big, unveiling, talking about his company and, talking about how incredible it is and what are their new expenditures, blah, blah, blah. That's one form of public information. Another form of public information would be essentially these public, very strenuous documents released by companies. What you see here is what we call a Form 10K. It's where you will find all the financial statements of a company, that's listed on the NASDAQ or, different stock exchanges, okay? And you would find their financial statements, you would find their thoughts on their company, you'd find a bunch of different jazz about the company. This would just be another way to essentially analyze public information to figure out some prices, to figure out whether it's a good investment or not. So what I'm trying to say here is that the key topics that you want to understand when analyzing a semi-strong form market efficiency is that you need to look at the different types of public information. And these different types of public information may be brought up in a question on your exam, but you need to understand that public information could not be used to beat the market under a semi-strong form. And this can be further highlighted right here. As you can see, whatever's highlighted in blue in these gray boxes are already priced in the stock. So you cannot beat the market with these two types of information. And by that same token, you would only be able to beat the market with private information, because essentially past and public information are priced in the stock. However, private information is not priced in the stock. So to tie a bow on this, we would say at the very bottom of this thing, we would say, hey, investors can beat the market by studying past prices and public information. However, investors can beat the market and earn abnormal returns by leveraging, so by using private information. So I feel like at this point, it should get a little bit more clear for us. And let me ask you this, and I'll ask everybody in the chat. What type of information could investors use to earn abnormal returns if the market is semi-strong efficient? What type of information could they use? Write it in the chat. What type of information could they use? Bishir says private information. Do we agree with Bishir? Or do we not? Lean, Tanvir, Rami, what do y'all think? Yeah, no problem. So if we are in a semi-strong form market efficiency, what type of information could investors use to earn abnormal returns? Past information, public information, private information, what combination? Okay, so Lean says private, Rami says public, Bashir says private. We miss one last answer. Exactly, that's the best answer right there because it explains why. Private information could be used to earn abnormal returns since public and past information are already priced in the market prices. Now, that's super important. Notice how these little boxes here are literally telling you what's priced in. So past is highlighted in blue, public is highlighted in blue, and then private is highlighted in gray. So you clearly see what answer you need to make. Now, if I were you, I would add this into my cheat sheet because I would know exactly how to kind of like analyze my stuff. Oh, this information's here, this information's here. Therefore, we could only use one type of information. Rami, do you understand your mistake? How do you feel? And do you have any questions? Do you have any questions, if anything? Okay, you got it. Now, before we move on to the strong form of market efficiency, do we have any questions? How are we feeling? What's up? Any inquiries, or are we good? Exactly. Literally, we're climbing a ladder. We're just going from one to the other. And if we go through A is going to B as well. You know, it's really just mixing things together. And that's what you're going to see on the next slide. It's that everything right in our gray boxes are going to be highlighted in blue, and then nothing will be highlighted in gray. Okay, so that's pretty cool. Notice how everything is highlighted in blue and nothing is highlighted in gray. That's the progression of our, forms of market efficiency. So what you see on the screen here, I tried to be funny, but it's not really funny. It's you have Martin Shkreli, essentially degen God himself. You have right here the classic, essentially, whatchamacallit? I forget how he called this. Let me see. Gupta. I think this is the classic Gupta incident. I don't know if it's with Valiant though. Let me see. No, okay. So this essentially what I put here is just, an incident between a management consulting firm and a head of investment banking at Goldman Sachs. This person apparently, allegedly, and was found by the court to have, shared some information that was said to be private within a board of directors meeting to another person, and that kind of created an issue. So essentially, he kind of shared some information that he was not supposed to, and that person who got access to that information did end up buying stocks, apparently. I could be butchering the story. But what I'm trying to highlight on the screen, and you can see it by this little right here, is that some information should just not be shared. Some information is privileged. Some information, actually, when you join a company, is said to be, bounded by an NDA, a non-disclosure agreement. So it's really, muddy waters when people try to benefit from this private information, and especially when it's public knowledge who owns a stock. So if you just so happen to own a stock with some privileged information, there's no way to deny it. And this is a little bit what I'm trying to picture on the left. But what's really cool is that in a theoretical, in an absolutely utopian planet, market prices would reflect all past prices and all public and private information. So I need to add private right here, and private information, such that whatever, even if you have insider information, you wouldn't be able to beat the market because it would already be priced in. Past prices, public information, and private information would be priced in the market prices such that it would be impossible to earn abnormal returns, okay? Because everything is just out there, everybody's fully transparent. Insider trading, just to double down, is literally what we discussed with this whole Jeff Bezos thing, with the little examples I gave on the left. So I don't know if we need to tie in so much information, but I would like to kind of just summarize it one last time. And as you can see on the left bottom hand side of the slide, investors cannot beat the market by studying past prices, public information, and private information. What does that mean? This means that investors could not earn abnormal returns by studying past public or private information. So, as I said in a very non-poetic way, anybody trying to find mispriced stocks are going to be capping. It's impossible. Okay, so that's kind of like the summary of the strong form market efficiency. So essentially, the strong form exists because it's the absolute top tier market efficiency. Unfortunately, insider trading is still being done, such that there is a benefit to essentially, trading illegally. And essentially, what the strong form market efficiency tries to do, it's like the standard, the golden mark. And we'd like to assume that there is such a market, which I don't know if it's really the case. So that's kind of like the three different segments available. So yeah, I hope that answers your question. Do we have any other question about the strong form? All right. So what I did, I created this little summary, and obviously you can zoom in, but essentially what this tries to do is this tries to just say, hey, we have all these different types of market efficiency. We have our weak form, we have our semi-strong form, we have our strong form, and we have none of the above. You could be none of the above technically. And essentially what I tried to do is I tried to create two segments, one of which is the priced in information, and the second one being the not priced in information. And at which we're going to find the intersection of the form of market efficiency with what is priced in and what is not priced in. I would definitely recommend choosing and using this as I'm studying, and also into my cheat sheet, just because it gives you a very clean way to see really quickly, well, hey, what is priced in and what is not priced in under this type of environment. So if I ask you this, and I'm gonna just make sure you guys understand, if we're under a strong form market efficiency, what is not priced in? Can somebody tell me? What is not priced in? What type of information is not priced in under a strong form market efficiency? What is not priced in? What isn't priced in under a strong form market efficiency? If you could read the slide, you're going to get the answer. Okay, I got 2 answers. I'm missing 2 more. What about Rami and Bashir? What do you guys think? What is not priced in? One last one. Rami, what do you think? What is not priced in under a strong form market efficiency? What is not priced in under a strong form market efficiency? There you go. So none of the above. Everything is priced in. You know, no information can be used to earn abnormal returns or to beat the market. So then let me ask you this. What is not priced in under a weak form market efficiency? What is not priced in under a weak form market market efficiency? What is not priced in under a weak form market efficiency? There you go. Amazing stuff. This is very good. I'm very happy. So it seems like this is getting easy. Okay. My last question. This one is not a trick question, but it's fun. What is priced in under a inefficient market? What is priced in under an inefficient market? Wink, wink. What is priced in under a inefficient market? A inefficient market, not a weak market, a inefficient. It's not efficient at all. Exactly. Exactly. Inefficient market is none of the above. It's not weak form. So it's not weak form efficient. It's not semi-strong form efficient. And it's definitely not strong form efficient. So right here, I took the pain to essentially highlight what would happen if we're dealing with an inefficient market. Okay. So to conclude this whole market efficiency thing, it's that market efficiency, once again, refers to the degree at which market prices are reflecting all available and relevant information. With that said, we're going to do some multiple choice questions together just to kind of, put you through the reps. I need every single person here to answer, and then we're going to see what's the answer together. Okay? It's going to be quite fun. It's going to put you under the test. And I also gave you homework to do after this session. That's going to be due for our next session. Now, obviously, I'm not going to run after you to do your homework, but I know that you want to succeed. You paid to succeed. You are trying hard. The only thing that we need, to really make sure you get that like 75, you get that A. I know some of you just want to pass, but it's always good to surprise yourself, is to do the homework and then send it to me on our chats. I'll literally look at it through one by one. I want to really help. So this is kind of like me trying to motivate y'all a little bit. So that said, let's look at it together. Let's check it out. So this first question, technical analysis, okay, which is defined as the analysis of historical trends of prices, is an important field in finance. Which form of efficiency is this field based on? Which form of efficiency is this field based on? I need one more answer. One more answer. Which field is this based on? Hell yeah, okay. I guess you guys are pros. Yeah, the answer is A. It's essentially weak form efficient. We spent so much time talking about it. So it's really good that you understand that. Great stuff. Then let's look at the second question, okay? You've observed that every time the Andrews Sister Music Corporation's stock rises by 2% in a week, it drops by 3% the next week. This observation is consistent with which form of market efficiency, okay? Which form of market efficiency? Read the question carefully. It's consistent. This means that which form of market efficiency does this follow? All right. Oh, and let me just add another option, I guess. I'm gonna add 2 more options. I guess something didn't go in. Sorry about that. So now you have till F. Try again. Sorry, you have till F. I added 2 options. Obviously, it's within the two options because or else I wouldn't have to add anything. But Lean says E. Lean says E. What do y'all think? What form is this consistent with? Not what form did we talk about this in? So exactly, the answer would be F, okay? This is inefficiency, all right? Being able to look at past prices to beat the market is totally inefficient, right? In this case, if you were to be an efficient market, right? If you were to be an efficient market, therefore, everything would be essentially priced in. All of this would be priced in. But now we're telling you that we're using past prices to beat the market. In what world are we using past prices to beat the market? We're essentially in an inefficient market, right? That would be the scenario. Gotcha. Does that seem clear? Is that clear? Does that make sense, Bishir? Like, what's the ambiguity here, in your opinion? Processing, okay. And I guess I'll talk about it a little bit more. Yeah, sure. But the idea is that the random walk, by the way, what is the random walk? The random walk is saying that the price of a stock today has no influence on the price of a stock tomorrow. So by definition, this would not be the random walk. This would be essentially breaking the rule of the random walk. Is that clear to Paramvir and Bishir? That this is essentially breaking the rule. We're telling you, hey man, if you look at a price today, you will be able to find the price tomorrow. That's totally against the random walk. The random walk states that the price of a stock today will have no impact on the price of a stock tomorrow. Obviously, we could say the price of a stock today would have no impact on the price of a stock a year from now, okay? So for that reason, this breaks the rule of the random walk. Now, the random walk is a rule associated to the weak form market, okay? But we're not following that rule. Therefore, it's for sure not weak form. And because it's not weak form, there's no way in hell it could be semi-strong form. Because a market that is semi-strong is also weak. You know what I'm saying? But like it's a ladder. They kind of go together, right? And a market that is strong is also semi-strong and also weak. It follows the same rules. This obviously has something to do with inefficiency. With efficiency. And yeah, exactly. It's inefficient because we're looking at past prices. We're breaking the rule, right? A market is inefficient if you could look at past prices, if you could look at public prices, and if you could look at private information. So sorry about that. I'll restate in one sentence. A market is inefficient in which you're able to look at past information, public information, and private information. But the biggest differentiator here is that you're able to use past prices to beat the market. That's like the big, portion of a inefficient market. So for that reason, we have this right here, which would be answer F. All right, let me just say, can't talk right now. Okay, so let's move on to the next. So this one's cool. So which of the following statements is most correct? So which of the following statements is most correct? So if a market is strong form efficient, this implies that the returns on bonds and stocks should be identical. If a market is weak form efficient, this implies that all public information is rapidly incorporated into market prices. C, if your uncle earns a return higher than the overall stock market, this means the stock market is inefficient. Statements A and B are correct, that's for D. And then E, none of the above is correct. This one's interesting. Bashir says E. Hamir says B. Rami says E. Yeah. The answer here is E, because all of these statements are kind of like fugly, right? Like they're not really on brand. A is totally wrong, right? B is not necessarily true. For sure, if a market is weak form efficient, we know that historical prices are included into the stock market. It doesn't mean that public information is included into the stock market, right? Public information could be used to earn abnormal returns. And for that reason, it's not quite true. Now for C, your uncle earns a return higher than the overall stock market, then this means that the stock market is inefficient. Well, no, not necessarily. It depends why. Okay, so that's not necessarily true. And then A and B are definitely wrong. So E would probably be like the best answer here. Okay. And then finally, this one's a fun one. It's a long question, but it's cool. So your quantitative research team at blah, blah, blah reports that they identified a successful trading strategy. The team claims that superior returns could be achieved by purchasing Canadian stocks whose prices have increased at a higher rate than the increase in the Toronto Stock Exchange S&P TCX stock market index. Wow, so much words for nothing. Over the past 6 months. If this is true, the existence of such a trading strategy would be evidence of what? A, that the stock market is, not being it's evidence against the stock market being strong form efficient. It's evidence against the stock market being semi-strong form efficient. It's evidence against the stock market being weak form efficient. And then D is A and B, E is all of them. So what is the answer here? What is the answer here? Quelle est la réponse ici? So I got one at D. I got one at D with Bishir. I would need a few more answers. Take your time though. This one has a lot of text, but if you just take out the long names, they're it's pretty straightforward. Tamvir says D. Rami says E. Lean is the only one that I'm waiting for now. What you got? E. Okay. Well, congrats, Rami, and congrats, Lean. The answer is E. The answer is E, and let me tell you why. Now, I understand the mistake that was done by Bashir and Tamvir is because we typically associate the topics we heard in the slides we looked at to being the answer. That's not always true. In this case, the question is telling you, hey, you're able to earn higher rates of return than the stock market index over the past 6 months, right? This is like your successful trading strategy. Your trading strategy, essentially, is looking at Canadian stocks who have beat the market in the past. You're looking at past information to figure out what you need to buy today. So you're looking at past information to beat the market today, to make an investing decision. Now, if we are under a weak form of market efficiency, are we allowed to look at past prices to make abnormal returns? Exactly. Under a weak form of market efficiency, you cannot look at past prices. You could, like, stats is just another way to say that we ran some numbers on past prices to make a decision today. And for that reason, this is going against, the fundamental rules of the weak form market efficiency. And for that reason, A is wrong, B is wrong, and C is wrong, and therefore the answer is E. Okay, the answer is E. So is that clear to everybody? Before we move on to options, are we okay with this? Are we comfortable? Like, how are we feeling? Are we good? Do we have any questions? Yeah, for sure. Like that's normal. That's why what I would do if I, to be completely fair with y'all, me when I read questions like this on an exam, and yes, it's in the homework. I'm gonna hook you up with the homework right after. Me, if I see this on an exam, I literally just take this off. I don't care about that. Me, I only read this part, so I don't care about this. I don't care about this part. Okay, superior returns, that's pretty important. Okay, by purchasing something, okay, then the increase. So for me, this is pretty important. I'm so sorry that it's ugly like that, but just bear with me. And then I would just remove this because for me, that's a whole lot of, blah, blah, blah. And essentially, this would be these things that I've highlighted, although ugly, would be the only things that I would read to like answer the question. Because for me, titles of random companies that don't exist don't matter to me, right? What matters to me is the part where they say the team claims that superior returns could be achieved by purchasing Canadian stocks that have increased at a higher rate over the past 6 months. For me, that tells me everything I need to like answer the question, right? The name of the company, the name of the department within that company, the index they're comparing it to, I don't care. I just want to know what's the strategy. And with that, I'm able to make a sense of what I need to do. Yeah, what's up? Exactly. So in the weak form, you cannot use past prices to determine the current price or to just beat the current price. It's really about this idea of earning abnormal returns. So you can't use past information. You can't use past prices at all. Okay. Yeah. So essentially, past prices are included in the current price. Essentially, yes. Past prices are historical information is included in the market price today. Okay. So that said, let's get freaky with it. Let's start doing some options. Now, options are actually pretty like straightforward, I think, and we're gonna try to break it down together. And yeah, let's do that. So we have like 15 minutes, and we're gonna try to do as much as we can. And don't worry, in terms of actual questions, we're gonna do a lot of them on our like crash courses. We have 3 crash courses, like big crash courses, in which I have an options question at least in 2 of them. So you'll have coverage there. And obviously, you know my gospel by now is that in the recordings for exam 2, you have a bunch of option questions that we've done. And in the Google Docs, if you go into more exam 2 material, because exam 2 covers options, CAPM, portfolio theory, and all that good stuff, you'll have the solutions to options questions as well. So it's really fun. And if you have questions on options questions that you have on your own, you could send them to me and I'll do them for you. So you have so much exposure here. You just got to use me as much as you can in the next 10 days. But anyways, so when we're looking at options and futures, we're really only looking at options, okay? What we're going to do here is we're going to define what the heck an option is. We're going to break it down into its 2 buckets, and then we're going to identify 3 main elements that we actually care about when like dealing with this topic. Okay, so let's begin with the first part. What is an option? An option is the right, okay, to buy or sell an asset, i.e. a stock, at a specific price, so at a fixed price for a specific amount of time. Okay, let me say this one more time. I want to let it stick. A option is the right to buy or sell an asset at a fixed price. So that's a specific price for a specific amount of time. Now let's try to like maybe just write it down. An option would be the right, let's say, to buy. Okay, this could be an option, a asset, at $50 for a specific time. So let's say from December all the way to March. That could be one way to think about it. So you bought something for a specific price, okay? You have the right to buy something at a specific price for a specific amount of time. Simple like that. Now, what are these 2 types of options that we're going to deal with the most? Well, there is a call and then there is a put option, okay? The difference between the 2, they're actually the same as a definition that we just talked about. Now, the difference is what type of decision we're making. Under the call option, we're simply looking at the right to buy an asset at a fixed price for a specific amount of time. However, under a put option, we're looking at the right to sell an asset at a fixed price for a specific amount of time. So what you're doing here, right, You're just really getting one little nuance between the two. One is buying, one is selling, okay? So with that said, what we're gonna do is we're gonna create a little example, as a team together, just for you to really kind of see where we're going with this, all right? So let's check this out. Let's say that we wanna buy, I guess I'll use a different color. Let's say that we wanna buy, I don't know, Netflix. I'm gonna assume this is their ticker. I can be totally wrong. We wanna buy Netflix, okay? And we know that Netflix is trading at $50 a stock right now, okay? $50 a stock right now. And we have an opportunity to buy a call, okay? Which would give you the right to buy Netflix at $30 a stock, okay? Now, I'm gonna ask you a few questions and you only gotta reply yes or no, okay? So if Netflix, okay, is trading at 50 bucks and you have the right to buy Netflix's stock at a fixed price of $30 for the next month, would you rather buy Netflix at $30 or would you rather buy Netflix at $50? Say, just write the amount, 50 or 30. Bishil says 30. Lean says 30. What else we got? 30. Exactly. So you would rather use your right to buy Netflix at $30 than to buy it at its trading price of $50. That wouldn't make sense. Okay. So let's look at another scenario. Let's look at a scenario at which Netflix is trading at $45. I mean, the call, your option is at $45. So you have the right to buy Netflix's stock at $45 for, let's say, 1 month if you exercise your call option. So would you rather buy, or would you rather use your option, or would you rather buy it at 50 bucks? What would you rather do? Michelle says you would rather use your call option. What would you all like to do? Use your call option at $45 or buy it at $50? What would you rather do? Use your call option or buy it at 50 bucks? Exactly. How much money are we not spending right here? How much money are we saving technically if we're buying it at 45 bucks? Hell yeah, we're saving $5. Amazing stuff. Really good. Okay, cool. Now let me ask you another question. Let's say that our call option is at 60 bucks. Okay. Would you rather exercise your call option, so the right to buy, or would you rather buy Netflix at $50? What would you rather do? People would always, in this case, rather simply buy at 50 bucks. Okay. So if you buy at 50 bucks, okay, this simply means that you did not use your call option. You just didn't use it. You had no need to, right? You didn't need to exercise that, that opportunity. Did you lose any money then if you just didn't use your option? How much money did we lose here? Somebody write it in the chat. How much money did we lose? Assuming there's no premiums. Assuming there is no premium, how much money did we lose? We lost $0. We lost $0 because I didn't buy it at 60 bucks. I'm not a sociopath. I bought it at 50 bucks, and I just didn't use my option. And all of you who said the premiums in the chat, 100%. If there were a premium, that's the money we would have lost up front. So that's a call option. A call option, as we just saw, is super advantageous when, we want to buy a stock at a price that is less than the price of the stock right now, right? In this case, we thought this was a great deal when the call option was at 30 bucks. We thought it was a great deal when the call option was at 45 bucks. However, any price beyond, $49.99, right? The cent below, we would not use it. Okay. So that's crucial news. Now let's look at this idea of a put. A put is kind of similar in a sense. Okay, put is kind of similar. Once again, we're just looking at the idea of being able to sell. So let's look at Apple. All right, let's look at Apple and let's assume that Apple is trading at $100. Okay, and you have a put option. Okay, at call it $120. Okay, so you have the right to sell, Apple's stock at $120 if you exercise your put option. Would you rather exercise your put option? Yes or no? Tell me. Would we exercise our put option? Would you decide to sell your stock at $120 instead of $100? What would you rather do? Would you rather sell your stock to someone at $100 if it's trading at $100 or at $120? So the stock price in the market is $100 and you could sell it at $120. Exactly. And how much money are we making on this sale? We're making $20, right? We're making $20 because you're selling it at a price that's much more than that of the market. Now let's look at another scenario. Let's look at a scenario at which your put option was at $70. Would you want to exercise your put option? If you could sell it at $100 in the stock market, but you decide to sell it at $70, would you use it? Yes or no? No, you wouldn't sell it for less than what's in the market. You would be literally a clown if you did so. Gotta be at the circus if you're gonna do that. In this case, you would just lose no money and you would just not use your put option. So now we kind of have a framework going for us. We have a framework going for us. The last thing I'd like to do on this slide would be to define three things. The first one being the exercise or strike price. Now on the screen right now, okay, let's kind of go back to what we had. Let's go like this. What would be our strike price? What's the strike price on the screen right now? What is our exercise price with everything that we just talked about? What would that be? I see one answer. What would be our strike price? Without me giving you any definitions, what would it be? Bishir says 120, Paramvir says 120, Lean says what? Rami says what? What would be our strike price? Lean says 100. Okay. Lean, what is 100? What is the 100? Is it Apple's stock price right now? Then what would be 120? If you would think, what would be 120? What would that be for you? Like if you had to give it a quick definition in the chat. Like, is it the stock price? Is it the put option? Is it the Queen's Gambit? What is it? What is 100? So exactly, no, Apple would be the stock price. This right here would be the stock price, and then this would be our put option. So for that reason, 120 would be our exercise price. Okay, this right here next to the ticker is the stock price, literally in itself. But anyways, all this to say, the exercise price is literally at what price do you have the right to buy, or at what price do you have the right to sell. The premium is something that you may or may not see on your exam, but a premium essentially, what it is, it's the price you have to pay up front to have the right to sell or buy a asset at a fixed price for a specific amount of time. You can't just do this for free. Life is not that cool. There's a price to taking risks. There's a price to making money, right? There's a cost of doing business. So for that reason, that's a premium. And Bashir talked about it earlier, right? How much money did we lose? Well, obviously, in this case, if we made $20 and our premium is $5, then our profit would be $15, right? Because this is our premium. Our premium we had to pay out of pocket. Now, finally, a payoff. And I'll ask you this, between A and B here, which would be our payoff? What would be our payoff between A and B? What would be our payoff? Bashir says B would be our payoff. Hamir says 15 as well. Lean says B as well. Well, it's actually wrong. This right here would be our profit, because you're going to do revenue minus, costs. The $15 is our profit because we had a premium. Remember, this was our cost. In this case, our payoff would be this right here. It would be how much money we made before any payoffs. I mean, any premiums or whatsoever. Okay. So this right here is our payoff. All right. Now within the next 3 minutes, what I like to just highlight super quickly and then talk about the homework would be the following. Okay. What I'd like to say here is that a call could actually be drawn in a super simple way. A call could be drawn just like this, as which you can see here that this would be the stock price, okay, on the x-axis. So we're moving along the line of $0, $10, 20, 30, 40, 50, and 60. All of these are going to be our stock prices. Now within our vertical axis, we have our prices. We have our payoffs. Okay. We have our payoffs. And essentially, as you can see, you can have $0, $5, etc. Now, what's interesting here is that you notice that if we had essentially a strike price of $30, if we had a strike price of $30, okay, our payoff would be non-existent all the way to 30, right? Because we would never exercise it. But in the case that the stock price is above 30, right? If it's 40 bucks, it's 50 bucks, if it's 60 bucks, you notice that we start getting what we call payoffs. We start earning money, right? We start getting payoffs. Assuming that the stock price is 40 bucks and our strike price is 30, we would make $10. We would then make perhaps $20. We would then make perhaps $30, depending on what the stock price would be. And if we were to be able to exercise our call option. So that's super cool. You notice that super quickly. What I'd like to say here is that if the stock price is equal to the exercise price, we have what we call is at the money. Okay. So assuming the strike price is 30, and then the stock price, we'll call it P, is 30, you would have at the money. So it'd be 30 equals 30. In other words, you could say P is equal to S. And you would say that you're in the money any point here. You would say you're in the money. So at any point that your strike price is bigger than your price of the market, so if 40 is bigger than 30, you would say that you're in the money. And you would say that you're out the money at any point right here, right? Because you're making literally $0 payoff. So this would be a point at which the strike price is smaller than the price in the market. Okay, so I just want to give you a visual representation of what this is, because this will be an amazing tool for you to be able to draw what we call payoff diagrams. And we're going to do that much more in our crash courses. But if you look once again at the recordings and all that good stuff, you'll see how to do it. And nobody would buy an out of money option. But you could buy an option that's out of the money right now. But you're going to predict that it's going to be in the money in the future. Very important nuance here. Nobody would ever buy something that's going to be out of the money forever. You're going to try to understand and kind of like play their odds of something being in the money at a certain point, right? So that's where it gets interesting. And we're going to look at that in just a second. So I'm kind of trying to run through this. Now, as you can notice, what we have here is that, let's say your strike price is $30 and you have a put, you would only exercise your put when the stock price, so this is S, so the stock price. So you call this as P. So the stock price is like 30 bucks, 40 bucks, 20 bucks, etc. You would only start making a payoff. So you'd only be in the money at any point below 30, right? Because at this point you would be making, $10. At this point you would be making 20. At this point you'd be making 30, right? So that's when you would exercise a put option. Now, in the last second that I'd like to cover here is I created this really cool, maybe not as clear if you zoom in here, you have the call and you have the put. I created different factors affecting option prices, right? I created a little graph for you in which you could see what's the relationship if the stock, the asset, its price increases, what would happen to the price of a call? what would happen to the price of a put? So what's cool here is that you notice, and here are 5 core factors that may affect the option prices. And as you can see, for a call, there seems to be only one factor that would actually decrease its price, its value. And you can see that there would be only 2 options that would decrease the price of a put, which would be higher interest rates and then higher asset prices. So that's super cool. So you get to kind of have something, because this is a question that you typically see on an exam as a multiple choice. So it's always good to have this on hand and just quickly look at this graph and say, okay, this would affect the price of a call, this would affect the price of a put, and in which directions. Now, the last thing I'd like to cover before we talk about the homework really quickly is a good summary. Now, if you expect the price of a stock to increase, okay, you believe that is this chapter more theory? I think it's divided into 2 segments. You're gonna have one question that's related to a computational question, so building a payoff diagram and discovering what's the profit. Then you're gonna have another question that's gonna be related to theory. Typically, it's related to this table right here. Typically, okay? That's why I took the time to make this graph for you. But to go on to this idea of the summary, you may ask yourself, well, when would we buy an option, or when would we buy a put? Well, it makes sense. So let's imagine that you expect the price of Nike to increase. Okay. Well, in that case, you should buy a call, right? You should be able to buy a call if you expect the price to increase of a stock. Because if you think Nike's going to jump to $100 and you are able to buy a call at $50, well, you're going to be saving $50, right? And if you expect the price of a stock to increase, you should probably sell your put as soon as possible, because the more your price increases and the less your put moves, at a point you'll be making no more payoffs. Okay. Now, on the other hand, if you expect the price of a stock to decrease, what should you do? You should buy a put option, because then you'll have the ability to sell at a specific price for a long time. So if your put option's at $100 and you think Nike will go to $10, well, maybe you should buy your put as soon as possible, because you could have the option to make a lot of money, no pun intended, okay? And the same thing goes for a call option. Well, what do you do if you expect the price to decrease? Well, you should probably sell your call as fast as possible, because at a certain point, the price will be smaller than your call option, and there would be no reason to exercise your call option, because you'd be spending much more money than what's the price in the market. Now, when you watch the recording, kind of write down what I just said, and try to look at it with just some little numbers, or look at our little graphs here. They're going to make sense of it for you. Now, the last thing I'd like to say here. Now, this would not be the same. This will be actually Wednesday. And this will be, I guess Wednesday was June 9th? No, June 8th. This will be June 8th. I would like you to do the following pieces of homework for the 3 chapters here. CAPM, market efficiency, and options and futures. I told you in which document this is, okay, right here, okay? And you know what pages to do, so please give it a shot, all right? Page 18 to 25, page 32 to 35, and page 36 to 41. If you wake up at 8 o'clock in the morning or 7 o'clock in the morning, and the first 3 or 4 hours of your day, all you do is 308, then you go on with your day or your work or whatsoever, you will have so much more power in the evening. Because 1, you won't feel stressed to study. 2, you'll be really, really on the ball during our sessions. And 3, you won't feel stress at all in just terms of your process, because you did put in the work. And it gives you the opportunity to send me your work, and I get to work on it during the day and send it back to you at night. It's a really good mixture to have. So covered call and protective put, you won't have any computational questions on that, but you may have a random theory question on it. I would suggest looking at your tutorial questions and seeing if there's anything related to covered call or protective put. I've never seen it on my exams. I actually never even bothered studying for it on my exams, because I knew the chances of it being there are so little. Okay.
Yeah, so it's not in the book, and but it's on the course outline it says it's covered, and my professor, he gave his own slides he made, and he said just cover it just in case, but
Then I would
it's
say,
not in the book.
I would say look at it just in case. See if there are any like tutorial questions related to it. I haven't seen any. And if you do have one, don't hesitate to send it to me and I'll break it down for you. But I don't think it's like what I would focus on. I would focus on like, literally building a payoff diagram, building a profit diagram. But if you do have those slides, it would be, it wouldn't be the best thing to not study them. So take the time to look at them. Okay.
Thanks.
No problem. Do we have any other questions before we kind of close it off? Okay, so this is the homework. The recording is going to be posted in a bit. This little thing is already posted. It'd be really interesting that you give it a shot and really use me as much as you can. We still have 10 days, to the date of the exam, I believe. Yeah, 10 days. So, the ball's in your camp. You have all the tools in the world out there. What's up? What's good?
Just a last question. So for the CAPM, the computation of alpha is like is it covered?
Yeah, that you need, but it's like so easy to do. You actually have a question on it in our practice problems.
Yeah,
And
that's
in
what
our,
I'm doing, but I couldn't find like the solution. So
oh yeah, but you have the formula, right? You have it in your what's in Moodle. You have it there.
okay, I'll look into it. Thanks.
And two, by the way, if you go in our Google Docs, literally just go into like final exam material or
Yeah.
more exam two material and just go through these documents one by one. You will find the solutions and you'll find like a bunch of different ways to do it too. So like take the time to go through them. There's like so many things available to you.
Thanks.
Okay, well, on that note, I'm gonna go drink some water and I'll post everything. You know that you can message me at any time. And yeah, we'll work through it together. So talk soon. Good luck. Keep on working. We got this. And I'll talk to you in a bit. Ciao, ciao.